Welcome to Deloitte's Dbriefs tax webcast series in Asia Pacific. Our webcast today is from our Geography Update series and is titled China VAT Legislation Update. My name is Candy Tang, and I'm a tax partner of Deloitte based in China. I'm now leading the VAT practice of Deloitte nationally in China. I have the pleasure of hosting today's webcast. I have two speakers with me today, Li Gao and Janet Zhang. Both Li and Janet are my fellow partners in Deloitte China. You may access our bios on the left side of the screen. Before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you may submit at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Download and the Links box. On the other hand, mobile device users can view the slides and answer the survey on screen. Thirdly, if you require an attendance record for this event, you will receive an automated email with CPE certificate after watching for 50 minutes. Now let's take a quick look at the topics we'll discuss today, which is about the newly published draft implementation regulations of the China VAT law. As you may know, China published its very first VAT law on December 25th, 2024, which was the Christmas Day. Although it is the very first VAT law in China, it's not brand new. As a matter of fact, the law carries over the existing China VAT working mechanism, like output minus input, taxable supplies, VAT rates and incentives, etc. with some changes. However, as the law itself only provides principles without many detailed guidance, people are very much looking forward to this implementation regulation of the law. On August 11th, which was last month, the Chinese authorities published a draft implementation regulation for public consultation for 1 month. This draft implementation has got lots of attention, and we have organized a series of seminars in over 15 cities in China, which were all very well received. Today, we organized this English webcast to share with our foreign audience on the draft implementation regulation. Specifically, you will learn from this webcast of recent development of the China VAT legislation, highlights on the key changes, and how to get ready for the VAT legislation. We are also pleased to answer questions in the Q&A session. Now, let's move on to take a look at the recent development of the China VAT legislation. On this slide, we have drawn a roadmap. From this map, you can see the whole development of China VAT. In summary, China introduced the VAT system back in 1994, launched the VAT reform to convert the service sectors such as financial service sectors, construction, and real property sectors, which were taxed under another turnover tax called business tax, to VAT during 2012 to 2016. So in China, all businesses are subject to VAT after that reform. Then, since 2017, the Chinese government continued to reform VAT in China by cutting down the VAT rates. For example, the highest rate of 17% was reduced to 13% on the supply of tangible goods, and also allowed taxpayers to apply for a cash refund of unutilized input VAT credit, which brings a cash flow benefit to the taxpayers. In 2019, the Chinese government started the VAT legislation process and finally released the formal law last year. The new VAT law will take effect on January 1st, 2026. Associated with this new law, the Chinese authorities released the draft implementation regulations for public consultation until September 10th. It is generally expected that the draft implementation regulations may be revised based on public consultation and released within the year of 2025 to facilitate the launch of the law on January 1st next year. If we look at the draft implementation regulations itself, it contains 6 chapters and 57 articles to provide supplements and detailed regulations to the law. The draft implementation regulations also introduce some critical clarifications and changes, such as the definition of the place of supply rules for services consumed in China, withholding agents, deemed taxable supply, input VAT recoverability for assets which are used for both VAT taxable and VAT exempted supplies, mixed sales, and the introduction of the general anti-tax avoidance rules. All these changes are very important and shall be examined so as to assess the impact on the business operating in China. Before I invite Liqun and Janet to share the detailed changes, let's go down to do the first polling question of the day. The question is, how do you think the draft VAT implementation regulations will impact your business? And your options are mainly positive impact, mainly negative impact, both positive and negative impact. It looks no impact so far, or I don't know. You may click the box for your answer. While we are waiting for the results to come in, Liqun, may I ask you a question? What's the relationship between the VAT implementation regulations and the VAT law? Will the regulations provide all the specific details for enforcing the law?
Thank you, Candy. The VAT draft regulations are an important supplement to the VAT law and provide detailed implementation guidance regarding the principles stated in the law. But we don't expect the implementation regulations to cover all the details necessary for enforcing the law. The business realities are very complicated. The implementation regulations should be followed by multiple separate circulars to be issued by the MOF and STA to provide specific guidance or to address specific questions.
Okay, thank you, Liqun. I think we have the result already on the screen. It seems that around 34% audience don't know, and then 20% says no impact so far, and then only 30% of the audience says positive and negative impact. So it seems we have a very interesting result, and then we will see if you will have enough information to redo this polling question after this webcast. And then let's move on. So I think, Liqun, I will pass over to you to introduce some of the highlights on the key changes. Liqun, over to you.
Okay, thank you, Candy. Under the current VAT rules, as long as the service provider or the service recipient is in China, the service is considered as supplied in China, and that's subject to VAT in China. The VAT law made a change to this principle. It provided that if the service provider is in China, or if a service is consumed in China, it is deemed supplied within China. So what is consumed in China is very important in determining the VAT liability of a supply. The draft implementation regulations provide further clarification on this point. Here are some situations where services are considered consumed in China. The first situation is services supplied to a domestic entity or individual, unless the service are consumed entirely overseas. Well, this is similar to the current rules where we look at the service recipient's locations. But there is an exception. The exception is services consumed entirely overseas. A quick example is an employee of a Chinese entity traveling to overseas and consuming accommodation or catering services out of China. Accommodation and catering services are easy for the determination of place of consumption, but some other services may be more complicated. So we are expecting that there could be challenges in practice on how to determine whether a service is consumed entirely out of China. Another situation is services supplied by a foreign entity or individual, and the services are directly related to goods, real estate, or natural resources in China. Please note that in this situation, where the service recipient is does not make a difference. For example, foreign company A purchases products from a Chinese supplier, and company A engages a service provider, foreign company B, to perform testing on the products provided by the Chinese supplier. Although both the service provider and the service recipients are non-residents, since the testing service is directly related to goods in China, the service should be viewed as being consumed in China. In practice, what is directly related to will be important for the assessment of the Chinese VAT implications. We are expecting the authorities to provide further guidance in this regard. Next slide, please. The current VAT rules provide that when a non-resident has VAT liabilities in China, the Chinese purchaser should act as the withholding agent of the non-resident to handle the VAT filing and payment obligations. The VAT law retained this rule and further provided an exception where a Chinese local agent can be appointed as withholding agent according to the rules to be published by the State Council. It is generally understood that such exception address the situations where Chinese service recipients are individuals and are not able to handle the withholding obligations. This is mainly relevant in e-commerce, especially in B2C businesses. The draft regulations stipulate that a foreign taxpayer leasing immovable property in China to an individual would be required to appoint a domestic withholding agent. However, it is not specified whether this requirement would extend to other situations, including e-commerce scenario, as I mentioned just now. It is to be clarified by the authorities whether individual purchasers would act as withholding agents. Let's move on to the next slide. Under the current VAT rules, there is quite a long list of transactions that are considered taxable under the deemed sales provisions. The VAT law shortened the list by removing some transactions that could be covered under normal taxable supplies. For example, providing products to a subsidiary as capital investment was removed from the deemed sales list. This does not mean that such a supply is no longer subject to VAT. Instead, such a supply is a normal sales transaction, just the sales proceeds in the form of equity interest in the subsidiary instead of cash. The VAT law also removed free-of-charge services from the list of deemed sales. The draft regulations did not amend these rules further. As a result, there have been some discussions about whether taxpayers would no longer be subject to the deemed sales rules in some commonly seen service scenarios. For example, provision of interest-free loans between related parties or rent-free leases. However, it remains uncertain whether some free of charge service arrangements might be challenged by the tax authorities. For instance, whether they would question the free nature of a transaction and seek to recharacterize such arrangements by applying the anti-avoidance rules. Okay, let me pass back to Candy here.
Thank you, Li Qun, for sharing. These are very important changes, while we do expect more clarifications from the authorities, as Li Qun mentioned. Janet, in the draft implementation regulations, there are lots of new measures being introduced on the input tax side. Can you please share with us these new changes?
Sure, Candy. Next, I will talk about the major changes in respect of input VAT in the draft implementation regulations. The first one is that the draft regulations disallow the deduction of input VAT attributable to non-taxable transactions, with exceptions only for the specific scenarios outlined in Article 6 of the VAT law. These exception items are shown in the bottom left of this page, including services provided by employees to employers, collection of administrative fees or government funds, receipt of compensation for expropriation or requisition, deposit interest income. For non-taxable transactions which are not exception items, the corresponding input VAT are not deductible. This rule embodies the principle of matching input VAT with the output VAT. That is to say, without output VAT, input VAT cannot be deducted. In theory, all the transactions which are not VAT taxable are non-taxable transactions, such as non-taxable compensation between enterprises, offshore trade, transfer of shares, transfer of a business, etc. So how to determine the corresponding input VAT related to the non-taxable transaction would be a critical and controversial issue. Take the transfer of a business as an example. This is a non-taxable transaction under current tax rules, and the input VAT are deductible. Assuming that such transfer of a business is still non-taxable under the new rule, it's unclear whether the input VAT related to the inventories, fixed assets, real estate involved is a corresponding input VAT and needs to be transferred out. Further clarification may be needed. Next slide, please. The second issue on input VAT is adding a new requirement of annual reconciliation on non-deductible input VAT. For certain transactions, including those subject to the simplified taxing method or that are VAT exempt, the relevant input VAT are not deductible and should be transferred out to be VAT costs. When the input VAT could not be distinguished clearly for the above transactions, the non-deductible input VAT should be calculated based on the percentage of sales of non-deductible items in total sales on a monthly basis. For example, if the total input VAT, which could not be distinguished, amounts to 10,000, and the percentage of VAT exempted sales in total sales is 40%, then the non-deductible VAT would be 4,000 for this month. The annual reconciliation here means that the non-deductible input VAT should be recalculated based on annual input VAT and the sales percentage. This may lead to an adjustment in the non-deductible input VAT for the year. Under the draft implementation regulations, this reconciliation requirement is a must requirement. However, under the current rules, it's not compulsory and subject to the local tax authority's judgment. This new requirement can prevent taxpayers to underreport non-deductible input VAT by manipulating the input VAT and sales recognition of each month. Nevertheless, it will increase the compliance cost of taxpayers. Next slide, please. On this page, we are talking about an important change in the input VAT policy for long-term assets. Long-term assets here include fixed assets, intangible assets, and real estate. Under the current rules, the input VAT on long-term assets used for both VAT taxable and non-deductible transactions is fully creditable for general VAT taxpayers, regardless of the original value. Non-deductible items include those subject to the simplified taxing method, VAT-exempt supplies, staff welfare, private consumption. This is a special treatment for the purpose of encouraging investment in long-term assets. However, under the draft VAT law implementation regulations, an allocation requirement would apply to single long-term assets with an original value exceeding RMB 5 million. Although taxpayer may claim a full input VAT credit upon purchase, they would be required to perform an annual adjustment, reversing input VAT based on the asset's usage in different activities according to its depreciation or amortization schedule. Simply speaking, for the long-term assets with original value lower than 5 million, the tax treatment remains the same as current rules. For those exceeding RMB 5 million, the input VAT related to non-deductible items are not deductible and should be transferred out to be cost on an annual basis. Next slide. Here is an example for your better understanding. Company Z purchased two equipment. Equipment A's original value is 6 million and the input VAT is 780,000. And the other equipment B original value is 3 million RMB and the corresponding input VAT was 390,000. Both equipment have a depreciation period of 10 years for both accounting and tax purposes. Two equipment are used for both items subject to the general taxing method and VAT-exempt items, for example, factory transfer business during this decade. In the first year, we assume that Company Z achieved sales revenue of 10 million RMB, including 4 million sales from the VAT-exempt items. So let's look at the different treatments under the current rules and the draft regulations. On the left-hand side, we can see that under the current VAT rules, the input VAT of both equipments are fully deducted upon purchase. There is no any input VAT need to be transferred out to be cost. However, look at the right-hand side. Under the draft VAT law implementation regulations, for the equipment A, as its original value exceeds 5 million, so although it can claim the input VAT fully upon purchase, but it needs to perform an annual reconciliation based on the asset usage. For example, in the first year, the input VAT transfer out amounts to 31,200. It's calculated as the total input VAT 780,000 divided by the depreciation year 10 and then multiplied by 4/10. That is the sales percentage of VAT exempted sales over the total sales. For the equipment B, since the original value is below 5 million, so the VAT treatment is the same as the current rules. That means the total input VAT could be fully deducted for VAT purpose. So from this example, we can see that for the long-term assets exceeding 5 million, for mixed purposes, the input VAT could not be fully deductible and will result in increase of VAT costs. In this connection, for those enterprises who have significant long-term asset investment in the future, it's suggested to look into this new policy and explore whether there is a way to mitigate the tax exposure. Next slide, please. This slide is about the input VAT on interest expenses. The VAT law actually does not explicitly list input VAT on non-interest as non-creditable, but the draft implementation regulations explicitly disallow the recovery of input VAT incurred on loan services and other costs directly related to loan arrangements, such as investment advisory or financing consultancy fees. This is the same as the restrictive position under current rules. That means taxpayers who earn interest income need to pay VAT at 6%. However, the taxpayers who pay interest expenses could not deduct the input VAT. It's not reasonable from the perspective neutrality principle. However, it seems not the right time to make a change now, considering that it may cause a significant drop in tax revenue. Next slide. After discussing the input VAT, now we move to another VAT issue, mixed sales. What is mixed sales? Mixed sales is a single VAT transaction that is comprised of two or more elements that would be subject to different VAT rates if supplied separately. A typical mixed sales example is selling air conditioners to consumers and in the meantime providing installation services. Although the VAT rate for sales of air conditioners is 13% and for installation services the VAT rate is 9%, but the total sales revenue should be subject to VAT at 13% since it's treated as a mixed sales. Under the current rules, a sales activity should be mixed sales if it involves both sales of goods and provision of services. Mixed sales carried out by entities engaged in production, wholesale, retail of goods shall be subject to VAT as sales of goods, and mixed sales carried out by other taxpayers shall be subject to VAT as sales of services. On the other hand, under the VAT law, if a taxpayer engaged in taxable transaction involving two or more tax rates or levy rates, the tax rate or levy rate applicable to primary activity of the taxable transaction shall apply. When we compare the current rules with the VAT law, we can see that there are two major differences. The first one is, under the current rules, mixed sales should involve both sales of goods and services, while under the VAT law, it emphasizes different tax rates are involved, but not necessarily both sales of goods and services are involved. In other words, mixed sales could be service A plus service B with different VAT rates. The second difference is that under the current rules, the VAT rate applicable to the mixed sales depends on the main business of the entity. But under the VAT law, it depends on the primary activity of the mixed sales, which may be different from the main business of the entity. As for how to determine whether the transaction is a mixed sales and how to determine the primary activity, let's move to the next slide. The draft implementation regulation of VAT law further clarified the conditions of mixed sales. A taxable transaction shall be deemed subject to the rates or levy rate applicable to the primary activity only if the following conditions are met. The first condition is that the taxable transaction involves two or more activities with different tax rates or levy rates. This condition has been mentioned in the VAT law. The second condition is that there is a clear principal auxiliary relationship between the activities. The principal activity plays the dominant role and reflects the substance and purpose of the transaction. And the auxiliary activity is a necessary supplement to the principal activity and conditional upon the occurrence of the principal activities. According to this article of the draft regulation, the tax authority will look at which activity reflects the substance and the purpose of the transaction, and whether the other transactions are supplemental to the primary activities. It may not be necessary for the primary activities to account for dominant proportion of the total revenue in some cases. As you may know, recently the State Administration of Taxation announced a circular in relation to express delivery services. It states that the income obtained by express enterprises from providing express delivery services shall be subject to VAT as collection and delivery services at a tax rate of 6%. Generally speaking, express services involves both collection delivery services, which VAT rate is 6%, as well as transportation services with a VAT rate of 9%. This circular, to a certain extent, treats the collection and delivery services as a primary activity of the mixed sales and stipulated that the total service revenue are subject to VAT at 6%, although the revenue of collection and delivery services may not exceed 50% of the total revenue in some cases. Mixed sales are always one of the most challenging areas in VAT practices, especially regarding disputes over whether a transaction should be treated as a single supply or multiple supply. It's suggested to communicate with the tax authority where the case is very complex and it's very hard to assess the tax position. Next slide, please. Similarly to the approach in income tax laws, the draft implementation regulation would introduce a general anti-avoidance rules. This provision would grant the tax authorities the power to attack arrangements that without valid commercial purposes. In details, where a taxpayer arranges transactions without reasonable commercial reasons and result in the reduction, exemption, or deferral of VAT payment, or the increase or acceleration of VAT refund, the tax authority have the right to make adjustments using reasonable methods and require the taxpayers to back pay the relevant taxes. Here, there are two key points related to this article. First, the taxpayer earn VAT benefits. The other is that the arrangement is without reasonable commercial purpose. So let's look at the example at the bottom of this slide. Currently, Company A is engaged in both sales of air conditioners and provision of installation services. It plans to have another company, that is Company B, to provide the installation services since 2026. After this business restructuring, there will be a reduction of VAT payable as a whole because Company B will report its VAT for the installation services at a rate of 9% instead of 13%. However, the tax authority may challenge this by making reference to these general anti-avoidance rules. Therefore, taxpayers may need to evaluate potential tax risk and consider how to effectively demonstrate their transactions are motivated by valid business reasons. Now, I pass back to Candy to continue.
Thank you, Janet. These are very interesting changes and very critical, may pose additional requirements for taxpayers to change their current process, controls, or even systems to accommodate the new requirements, especially on the input side. That brings us to the second polling question of the day. The question is, compared to the current policy, what challenges do you think the draft implementation regulations pose on your company's tax compliance? And you have multiple choices to select here. The first one is the annual reconciliation requirement for the inputted VAT of goods and services used for both VAT taxable transactions and other transactions. The second one is inputted VAT on long-term assets used for both VAT taxable transaction and other purposes. The third one is a separate accounting requirement for inputted VAT attributable to VAT preferential projects. The fourth one is the determination of a single supply and the identification of its principal element. The last one is the proof of business reasons following the anti-tax avoidance rule. So while we are waiting for the result to come in, Janet, I have a quick question for you. What's your observation on the feedback from your clients on this question?
My observation is that they are concerned about the input VAT on long-term assets used for both taxable transactions and other purposes. Because in South China, many of our clients conduct the factory transfer business, which are VAT exempt in Southern China. And also, many of our clients have the cross-border services provision, which are VAT exempted. So they have a lot of questions. For example, whether the rental could be applicable to this special policy, and also whether, if yes, how to determine the threshold of 5 million for rental, because there is no original value for a rental arrangement, and whether the decoration expenses of rented buildings could be eligible to this policy. For self-constructed buildings, how to allocate the input VAT for canteen, etc. So such a kind of issues are unclear. Yeah, maybe further clarification may be needed in the next step.
Okay,
Thank you.
So thank you, Janet. So their concern is mainly on the input side, especially for the purchase goods, services, and long-term assets used for mixed purposes. Okay, so let's see the result here on the screen. Very similarly as what you mentioned, Janet, I think the majority of our audience today also expressed their concerns on the input tax apportionment, especially for the purchase for mixed purposes. And then I think there are some around 1/3 of the audience also have some concerns on the mixed supplies, especially if it's single supply, then how to identify its main principle. And then for the bona fide business purpose, I think our audience seems quite confident on their business arrangement. I think that's a very good result and showcase what our audience are concerned about because of these new changes. Now, I would like to invite Liqun again to share with us the other main changes of the draft regulations. Liqun, please.
Okay, thank you, Candy. Well, in many countries, VAT rules, transfer of going concern is not subject to VAT. And we have similar rules in China. Under the current VAT rules, in the process of asset restructuring, when a taxpayer transfers all or part of tangible assets along with the associated creditors' rights, liabilities, and workforce altogether to other parties. The transfer of goods, immovable properties, and land use rights involved is not subject to VAT. Neither the VAT law nor the draft regulations clarify whether the transfer of a business or a part of a business as a going concern would remain non-VATable. Furthermore, as Janet mentioned just now in the input VAT part, the VAT law and the draft regulations provided no guidance on how to determine the input VAT attributable to such a transfer if the business transfer itself is deemed as non-VATable. So we are expecting that these matters may be addressed in the subsequent regulations to be issued by the tax authorities. Let's move on to the next slide. Under the current VAT rules, there are many types of VAT preferential treatments. To qualify for the VAT preferential treatments on eligible projects, the draft VAT regulations require the taxpayers to maintain separate accounting, not only for the revenue generated, but also for the input VAT attributable to such projects. The requirement to account for input VAT separately for projects eligible for preferential treatment is new. So this proposed requirement is expected to further increase the compliance burden associated with input VAT management. So let's move on to the next slide. Under the Chinese VAT rules, most exports of goods are exempted from VAT or qualify for zero rating. The input VAT for zero-rated exports may be refunded. The draft regulations stipulate that exporters would be required to file for a VAT exemption or refund within 36 months from the date of customs declaration to secure such a treatment. Failure to do so would result in the exports being treated as domestic taxable supplies. The draft regulations also would introduce a similar 36-month filing rule for exports of services that are eligible for a VAT exemption or zero rating treatment. This is an important change since no such timeline exists under the current rules. So taxpayers should review their export VAT filing timeline to make sure the proper VAT exemption or zero rating treatment is secured. Next slide, please. For taxpayers applying for the simplified taxing method, current rules permit sales discounts, allowances, and returns to be deducted from the sales revenue when calculating the VAT payable. However, if the total deductible items exceed the sales revenue, resulting in a net overpayment of VAT, the existing rules do not specify whether such overpayment may be refunded or must be carried forward to offset future VAT liabilities. The draft regulations now clarify that taxpayers would be eligible to apply for a refund of the overpaid VAT amount, although detailed procedures for the refund process have yet to be established and published. This proposed clarification is expected to help alleviate cash flow pressures for certain taxpayers. Okay, back to you, Candy.
Yeah, thanks Li Chu and Janet for sharing with us the key changes of the draft implementation regulations. I think our audience should have enough to digest after today's session. Then you may ask what the authorities' plan is when they will finalize and publish the formal implementation regulations and what the taxpayers should get ready for it. So maybe we move on to the next slide to share with our audience on what's next and then how to get ready for the VAT new rules. So from the authorities' perspective, as mentioned earlier, the authorities will review the feedback collected from the public and other channels, make the changes, and then finalize and publish the implementation regulations within the year of 2025. Moreover, the authorities may release other relevant circulars within 2025, such as the special VAT preferential policies to support the small and micro-sized businesses, key industries, innovations, entrepreneurship, employment promotion, and charitable donations. In addition, there are lots of discussions in terms of the scope and conditions for VAT zero rating and exemption treatment on the cross-border supplies, and it's expected that the authorities may issue separate circulars on this subject matter. One thing to note is that even when the new VAT law takes effect from Jan 1st next year, the tax authorities may continue to publish more detailed regulations and guidance on specific topics. So the China VAT legislation is still evolving, and please stay tuned and keep monitor development here. For the taxpayers, from now to the end of this year, we have some recommendations for you to consider. So first of all, closely monitor the development of the new regulations and assess the impact on your business from both finance, tax, and also business perspectives. Then the taxpayers should digest the new regulations and get prepared for the new changes, such as updating the tax-related working processes, enhancing controls, and even deploying certain automation tools or systems to accommodate the new requirements. If the taxpayers have any questions on the new changes, they can also seek clarifications from the tax authorities by themselves or with the help of the professional tax advisors. Then, when the new VAT law and its implementation regulations take effect on January 1st, 2026, the taxpayers can implement the new process, controls, systems, and also conduct periodical reviews to ensure ongoing compliance. When the authorities issue more detailed regulations or guidance, the taxpayers shall pay attention, understand the new regulations, assess impact, and seek clarifications from the tax authorities where needed. Last but not least, the taxpayers can continue to explore tax planning opportunities such as the VAT zero rating or exemption treatment, etc. Then let's move on. I think that brings us to the last polling question of the day. The question is, what kind of VAT services will your company primarily need in the coming 1 or 2 years? Again, we have multiple choices here for you to select. And the options are training and seminars for the VAT law, implementation regulations, and other relevant topics. Explore and implement opportunities for tax optimization, assistance in communication with tax authorities, set up or upgrade e-invoice or VAT management systems, or no aware or no plan for the time being. Please select the one based on your situation. And while we are waiting for the results to come in, Li-Chun, may I ask you a quick question?
Sure.
What's your suggestion, especially what imminent measures or actions that you would like to recommend our audience to consider?
I talked to some of my clients about the draft regulations. Some clients are concerned about the potential negative impact of some changes in the new regulations on their business. And since the deadline for public consultation has passed, they are concerned that they do not have any chance to communicate their views to the authorities. I would like to remind our clients that although the public consultation period has closed, there are still some different channels to make your voice heard. You can raise your comments through industry associations, chambers of commerce, and professional firms like us. So the implementation regulations are not finalized yet, and issues are still under debate. You still have chances to make an impact on the new VAT law in China.
Yeah, that's a very important advice, Li Qun. I think as we discussed, the China VAT legislation is still evolving, and the government is keen to hear what the business asks. So I think there are always a chance for you to ask questions. And also I see in the Q&A box, there are lots of questions on the timing of when the regulations will all be released to cope for the launch of the new VAT law starting from Jan next year, which is 3.5 months later. So I think people are also keen to know the regulations, and the authorities are also working on that. So let's stay tuned. I think we have the result now. Most of our audience are still looking for trainings like seminars and sharing. And many of them are also looking for the tax optimization opportunities. I think this is also very keen. So all the preferential VAT treatment, like the VAT zero rating or exemption treatment on cross-border services, I think these are all good opportunities that people can continue to explore. And 1/3 of the audience seems no plan for the time being. Maybe just they are still waiting for more regulations to come out. I think that's a good summary of today's discussion. Then I think we have 8 minutes left. So let's look at the Q&A box to see what the questions are. Yeah, Li Qun, there is a question for you. How will the local tax offices enforce VAT on services provided by a foreign entity to another foreign entity for goods located in China? Will there be double taxation then if the service provider's jurisdiction also imposes VAT on the same transaction?
Okay, thank you. This is a very interesting question. First of all, I think there is detection issue, how the Chinese tax authorities will find out if the service provider and the service recipients are both non-residents. Yeah, of course, there are ways they can find out, although the Chinese foreign exchange control is not effective in this situation because the payment also happens out of China. But if the Chinese tax authorities detect this supply, and because the supply is related to goods in China, is considered as taxable in China, then the current rules do not exclude the possibility for a non-resident service recipient, the purchaser, to act as the withholding agent. So in theory, the purchaser of the service, this, as in my example, the foreign company A who's engaging the service provider should act as the withholding agent, but it's also not in China. So this is a scenario where the authorities can ask this foreign company A to appoint a domestic agent to perform the withholding and filing obligations. Yeah, how such situations to be addressed is depending on the subsequent clarifications from the authorities. As to the double taxation issue, I think this is where the different countries need to adopt similar principles in determining the taxation rights and the place of supply. So if both countries adopted the rule of destination and consider the place of consumption as the place to levy VAT, then the problem of double taxation shouldn't exist.
Yeah, thank you, Li Qun. And Janet, there is another question for you. Is annual adjustment required to be performed if the overseas entity does not have an input tax in China?
Thank you, Candy. Yeah, for this question, the answer is no. I seen another question about a foreign entity, whether it could register for VAT. For an entity, you could not register VAT in China, and there is no input VAT. In that case, there is no any annual adjustment required. The annual reconciliation is only applicable when you have input VAT, and the input VAT could not be distinguished or allocated clearly among the VAT exempt projects and taxable projects. In that case, you need to use the stipulated formula to recalculate the non-deductible input VAT on an annual basis. So for this question, not necessary to do any adjustments. Candy, back to you.
Sure. Thank you. Thank you, Janet. Li Qun, there is another question for you. Provision of services to foreign parent company considered as consumed outside of China, like the exported services, and hence should be zero-rated or non-VAT taxable supply.
Yes, so services provided to overseas, they are under the current rules, they are generally exempted or zero-rated depending on the classification of the services.
Okay. So Janet, maybe another question for you.
Yeah.
Who has the burden of proof in the case of GAR? The taxpayer or the tax authority?
In general, in practice, I think both the tax authority and the taxpayer have the obligation to provide evidence, but I think the major one is the taxpayer. When the tax authority challenged that your arrangement is not commercially justified, taxpayers to need to provide proofs to substantiate that the arrangement is not only for the tax benefit, is commercially justified arrangement. So I think the major obligation is on the taxpayer. However, the tax authority also need to provide some proofs. Back to you, Candy.
Okay, thank you. I think we only have time for one question.
Maybe I give one additional point on the question I answered just now. For the cross-border services provided to overseas, there is always a condition to enjoy the exemption or zero rating treatment, which is fully consumed out of China condition, which under the draft regulations are still not very clear what services can be considered as fully consumed out of China. So we are expecting that further clarification is needed from the authorities on this point.
Sure. Thank you. Sure. Thank you, Li Qun. I think these are all the time we have for today. Unfortunately, that's all the time we have. So Li Qun and Janet, again, thank you very much for sharing. And also the special thanks to all of you who were able to join us. We would like to encourage you to fill out the short survey that will pop up on your screen momentarily and tell us what you think about today's program. If you joined us late, please know that this presentation will be archived for further reviewing. If you feel the others would benefit from this webcast, please share the webcast with the share this icon or have them visit the Dbriefs website. We will respond to all the remaining questions submitted during the webcast in a couple of weeks. Also, if you think of any other questions or comments later, please feel free to reach out either to me or to our speakers. We'll be more than happy to talk to you. And please do not forget to tune in to our next scheduled webcast from the corporate income tax on 23rd of October, titled Pillar 2, Impact on M&A Transactions. And last, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax Webcast today. Thank you and goodbye.